on every interval, usually on weekends, for our investors and traders and make them aware about the strategies, about the markets, and we also do webinar on request we receive at our end by the traders and investors across the globe. We try to focus on each and every market. It can be market specific, it can be strategies specific, or else it can also be about commodities, forex. So at Epic Learning Center, we try to inculcate all these suggestions by investors and traders and have webinar and make them aware and share with them our strategies and practical implications we use on day-to-day basis in the markets. I'm Loveless Sharma from Epic Research, and I'll be taking you through this webinar. Let us have contents. I'll let you know about us, the organization, about the markets, specifically KLSE and SGX. I'll be sharing some of the history and about the markets, which most of you would probably know. Uh, then I'll come on to the core principles of day trading. What are the core principles in day trading? How one can utilize day trading as one of the best way to maximize the return and make your cash, which is in banks or other investment you have, and make them utilize in day-to-day trading and optimize the return of your portfolio. I'll also let you through about technical analysis, value investment as well. Then I'll share some day trading strategies. Uh, we also have our own trading strategies at Epic Research that we share with each and every investor and clients we have across the globe. Then I'll let you through some charts about the market, specifically Singapore and Malaysian market chart, and we'll have a discussion on the market charts, and then I'll take your queries. I also request all the attendees to have a pen and paper, and if you feel any doubt or question, you can ask, and at the end of the webinar, you can note them down. And if you have any doubt or suggestions, you can also give that at the end of this webinar. So let's start with about Epic Research. Well, we are an ISO 9001 2008 certified company. We are a leading service provider with a presence in global capital markets. Epic has offices and representatives in United States, Singapore, Australia, Middle East. We have a headquarter of the company in India. We provide stock recommendation for SGX and KLSE markets. We have a full-fledged research operations. By full-fledged, I mean it can be from equity market to global forex market, and we are registered as an investment advisory company. We provide and deliver high accuracy stock tips and recommendations for Singapore, of course, Malaysian market as well. Our basket of services are from SGX equity markets, SGX derivatives. We have Nifty traded on Singapore exchange. We have KLSE equity market, KLSE derivatives. We are one of the leading and the only provider in FCPO and FKLI with a good consistency on the accuracy. Global commodities market, bullions like precious metals and energy. We have crude and natural gas. We also provide recommendation in agri like corns, soybeans, and other softs that are traded on the global market. Global forex, we provide major currency pairs recommendations. Uh, these are the bag of services we have. This can be varied, and we are trying to make our mark in different market like Shanghai and Hong Kong, and we will be trying to capture most of the Asian markets within this fiscal year, so that to provide a global presence in a global market and have clients across the global exchange. Let's start with KLSE, well, Kuala Lumpur Stock Exchange, which is also known as Bursa Saham Kuala Lumpur in Malay, started back in 1930. Now, this particular exchange was officially formed in 1964, and in the following year, with the succession of Singapore from Malaysia, the common stock exchange continued to function under the name Stock Exchange of Malaysia and Singapore. Uh, if you know most of the things, I like to point this out that it also fully suspended the trading of CLOB, that was a central limit order book counters, indefinitely, freezing approximately 4.47 billion worth of shares that affected 1,72,000 investors. This is the one of the history of KLSE. Well, Kuala Lumpur Stock Exchange became a demutualized exchange and was renamed Bursa Malaysia in 2004. It has a total market capitalization of around 700 billion at this moment. Singapore Exchange, holding invest company located in Singapore, and it's also a member of World Federation of Exchanges and the Asian Exchanges and Oceania Stock Exchange Federation. The companies listed on Singapore belong to two groups, SGX Main Board and companies listed on SGX SDAC. The Singapore Exchange Quest, that was quotation and execution system, it was launched in 2004. There are pre-open time, market open time, and pre-close and close time of the exchange, as you most of the investors are aware. Coming on to the main topic of this particular webinar, the core principles on day trading. See, the core principles on day trading, there are many principles if we look back at the history. Since 1900s, we have had many developments in the day trading with various things that came into the market, from Elliott wave to Dow theory to various indicators that developed over the time. Candlesticks have a way back history in the past. So there are a lot of things that come into day trading, and being a day trader, you have to know most of the thing. But as far as the investor go, we cannot be sitting in front of the system every day and do that and see all the factors. So at times you need an expert, the analyst and the advisor, to let you guide through the market and make you aware about the day trading. See, speed and fear. I've used this word is the essence of day trading, because most of the time you must remember to protect your capital rather than capturing profits. In this global financial market, when we have a scenario of 24/7 environment where data is coming at every second, from events happening like a recent event like Greece, or federal rate hike in September or December, when you have two-faced swords, many things in the market which are being discounted. So speed and fear. So it's not about just having the profit or capturing the profit. It also is about protecting your capital when you need to protect your capital and when you need to capture the profit. So speed is one of the things you should have. Always remind yourself to buy and sell quickly and take profit on a small price changes. Small price changes is another term, but trading setup is another term which we provide to our clients on daily basis in SGX and KLSE. When I say small price changes, that is one of the targets we define in the counter that we are predicting in an intraday basis. So this is one of the places where speed come in. You need to act fast, and your response time should be high. Fear. Fear is can be said into greediness or fear of losing the profit. This is also a different term. It can be used for greed, or it can be used for booking the profit or getting out of the market. So fear should be avoided when you are into the market. You should be having simple setups in the market when you are making a day trade. Basically, the center assumption of a speed and fear. Brief exposure to the market. You must have a brief exposure to the market. On a daily basis, you cannot do that. You might be into a job, or you might be into any business, or you might not be having that much time to sit in front of the system. So, brief exposure to the market is not about having all the data and resources, but having uh, theoretically clear about how the markets work and when to enter and when to book. Now, when to enter and when to book is where we come into the picture and try to help out the investors make profit on the day trading basis. So you must have a brief exposure. If you want to have any doubts or any clarity or any questions to be resolved, you should consult the financial advisor or the analyst you are having, or with your which is looking after your portfolio. So you must have a brief exposure. Smaller moves are easier to obtain as bigger imbalance of supply and demand is needed. Smaller moves are easier to obtain. That is very true when there is an imbalance of supply and demand. But this doesn't mean that every smaller move you need to capture. So it's not like you have to enter or make trade at every move you have in the market. You need to make moves on the right direction. So every smaller move does not give you the opportunity to trade, but most of the moves in the market are not meant to trade. So you must have an expert who's looking at the market, and he or she must advise you and tell you that this is one of the moves, or this is one of the counters, or this is one of the recommendation that you should work on and make the best out of it. This means you have to sit down at a computer entire day and watch for any price movement. As a purely day trader, you have to do this. But if you are engaged in some other kind of activities apart from day trading, then you need to have an expert advisor with you, an expert with you who's constantly guiding you and constantly looking after your portfolio or the counters you have a position in. So it's not about sitting in front of the market. But if you are a purely day trader who's working on recommendations, that you need to be in front of the computer so that you can have a better response time. Like I said, speed. Smaller moves are more frequent than the larger ones. Yes, smaller moves are more frequent in the larger ones because I'll share one of the basic principles that sorry, one of the basic principles that market is not every time trending. You will not get larger moves every time in the market. Market is 30% of the time trending. Now, trending markets are where the traps are, where people try to uh, enter the market. But these larger ones are the trap. Until unless you have a trade setup, until and unless you have the right point of entry in the market, you will not be able to make the best out of the larger moves. So try to move on smaller moves. Smaller moves are there 70% of the time when markets are in consolidation, or they are in some kind of a pattern, or they are in some kind of a channel which we used to call, that can be uptrend or downtrend, or that can be one of the trading ranges which we call consolidation. So these smaller moves are very easy to trade, very easy to capture, and with the right trading strategy, you can make the best out of the smaller moves rather than the large ones. The large ones are meant to invest in the market and make a capital appreciation on the longer horizon. But smaller moves, you need to act fast with speed, and you need to make the best out of it. Now, I won't suggest you enter in the market on every small move. Ask the advisor, ask the expert, and make him aware about your portfolio. And then, whatever the recommendation come in, you make the best out of the smaller move. Accept the fact that day trader lose in a while. Yes, day trader lose in a while. It is one of the global fact. Be ready to take a small loss, but never allow small loss to snowball that erodes your capital, which I clearly said that protecting your capital rather than capturing profit is the most important thing. So this, the first line, second line which we had, is the last line. Be ready to take a small loss, but never allow a small loss to snowball. Don't have any kind of a biasness in your mind, in your trading setup, or in your view of the market. If you have a biasness, that can be of anchoring, or that can be of a herd mentality, this particular biasness will lead you to a trap, and that may erode your capital completely. Advantages of day trading. See, as an day trader, you have many advantages. First of all, the basic advantage which you have is that you are 100% cash at the beginning and end of every day. You are 100% cash. You don't have anything as debt or anything in your portfolio. So every day when you come into the market or every day you leave, you make sure you're 100% cash and you don't have a debt portion. I would also suggest many investors that people try to take capital to trade on loan or on interest, but I would advise them this is one of the basic mistakes that everyone do. They try to make sure that they can get some return from the market and pay the interest they have borrowed and also make some profit. This is one of the biggest mistakes an investor do. So when you are trading in the market, make sure you 100% cash. You don't have any debt or borrowed money when you're trading to the market. You'll have twice as much buying power. Brokers do allow limits, and they also allow 10 time limits in the markets. So when you're even trading with, say, 10,000, you have 100,000 to trade in the market. So you'll have twice as much buying power in the market. But this buying power doesn't come easily. It doesn't make you have a full exposure on the market. It just means that you have a much higher buying power, but you don't have to invest all that in an intraday basis. You actually earn interest on your overnight cash balance. When you have a cash balance in your portfolio or some holdings, you actually earn interest on your overnight cash balance, provided you have the right counter in your portfolio and provided you have the right trading setup. You can make your dead money, which is in the bank or which is with you, earn interest on it. You can completely ignore the news, and also you'll gather a statistically meaningful sample size far more quickly. See, you can completely ignore the news. When you're into the market, there are many news that affect the market. But it's not like that you have to act or react on every news. Most of the news, when you trade in the market, is already being discounted. This is one of the famous uh, quotes I would like to say: price discounts everything. Now, when you're trading in the market, you have a price in front of you, you have a chart in front of you. So, when you're trading in the market, the price in front of you, you must be aware that this particular price has discounted everything, every particular news that is in the market. That can be stock specific, that can be market specific, it can be economic event, it can be geopolitical event. Of course, market do wait for any news to come up or any result to come up, but most of the things are discounted as we have a proper news flow in the market. So you have one option to completely ignore the news. Day trading can actually be less risky. Day trading, of course, can actually be less risky if you have a proper expert advisor with you who's looking after the portfolio. But don't go naked in the market and have any kind of counters to trade. Make sure you have an expert advisor with you who is looking at the market 24/7 for you and making best recommendations for you on daily basis. Well, these are some controversies which are in the market. When to buy or sell financial investment during the day, or almost seen as a form of gambling because people are very less aware about market or about the functions of the market, how it is done, which has now become one of the art and science when you do on a daily basis. So it is one of the things that people do think that it is basically a gambling, but it is not a gambling. It is a statistical place, and it is one of the financial engineering space where you once profit is others loss if you have the right news with you or the right expert with you. Moving on to the other slide, I'll let you know how this is where The technical analysis comes in when you're having a controversy on trade trading. I'll let you know, go through some charts at the end and discuss about the market as well, so that you can know how we try to provide the best of the recommendations and analysis to clients. Risk and return. uh, the more the risk, the more is the return. But it doesn't mean you need to take the risk high at every time to get the high return. So this is one of the risk return appetite things you need to understand, that if the risk is more, the return is more. But it generally does not mean you need to take high risk to get high returns. You need to have a brief about your profile and about your risk taking capacity, or risk bearing capacity to your financial advisor. Volatile markets create trap that may at times erode your trading capital. Like I discussed in previous slide, volatile markets does uh, create a trap for investors. Though if you are even in a trap, let your financial advisor guide you out of it. Ideally, the risk return ratio should not be more than 1 is to 3. Of course, when you're entering into the market, usually people go for 1 is to 1 risk return on the daily basis. But 1 is to 3 is if you want a return of 3 Singapore dollar or Malaysian ringgit, the risk taken should be ideally less than 1 or equal to 1, so that your returns are higher in every trade, and the capital exposure you are taking is just 1. So even if you have some loss at the end of the day, and you have traded in 2 3 counters, you know that the return has been overall higher as compared to risk you have taken in every trade. Present financial scenario, it's not about returns, rather it's about managing the risk. Yes, it's not about returns anymore. Returns can be there, but how you are managing the risk, what is the risk reward ratio you are having, that is one of the major issues in current market. A trader should consult the financial advisor and share his capital, return required, risk capacity, and risk aversion. Also, help advisor know each and every detail of your portfolio to establish a better communication and support promptly. Leveraging. Now, this is one of the things, that how much you are leveraging. Uh, as the word suggests, leveraging states trading more than the money invested. So, a trader, if invested 10,000 Singapore dollar or ringgit, and he trades for 100,000 using a leverage limit of 10 times on his base investment. Leverage is a always two-faced sword. If not used properly, this can harm you too. Of course, you know how to use leveraging, but effective leveraging always come with an expert advice. You cannot just leverage on your own and sit tight in the market, because markets react very fastly than the investor does. Over leveraging while trading is always dangerous for traders as a whole. So here I would suggest that you do not always leverage your position. As I said, even if you're getting a 10 time limit, don't completely uh, invest your all capital in the market. Leverage very less, or always invest 30 to 40% of your portfolio in a single recommendation, and save other 60% for other recommendations. Understanding stop losses. Stop losses is one of the things that investor need to understand. Most the investor skip this particular part and hold down to their positions. This is one of the places where biasness come in. You become part of herd mentality. You have an anchoring know that this particular stock or this particular counter which I am having is one of the best performer where it should be. So stop losses are very critical, and one should place a stop loss on every single trade he or she is doing on a regular basis. It limits your losses. It is important in market to know your losses than to know your profits. In a particular trade, you put a stop loss, so you are aware that this is one of the loss that I will bear in this particular recommendation, rather than profit. You know your profit, but you must know what is your loss in a particular recommendation is recommended. Stop loss is generally provided with each every trading call to the clients, which they should strictly adhere to. A trailing stop loss helps the trader to move his stop loss in the market direction. Trailing stop losses is one of the best strategies that a day trader or an investor should do on regular basis. When you have a particular counter, when you have entered into the market, so you make sure you have trailed your stop loss. Even if you have booked profit on first target or second target, you should trail your stop loss to the cost. If you're on second target and sitting still tight with your position, you should book 70 to 80% over there and trail your stop loss to first target, so that even your stop loss is triggered, you are making money out of the stop loss, you are not losing out of the stop loss. So one should know how to use stop loss. Stop loss is a very critical word. People are very uh, negligent to it, or have a negative feeling with this bird. But when you know how to make money out of the stop loss, it is by trailing the stop loss. When you have a position which is in profit, or which you have already booked 70% of the profit, the rest 30% can also make you money if you put a stop loss on first target or above your cost price, so that a stop loss is also giving you money at the end of the trading session. The technical analysis and value investment, these are two perspectives that every trader should know. Technical analysis is evident Technical analysis is evident while investing in markets. That can be from the perspective of trade trader to short term. While value investing, we have other things like margin of safety, price to earning, earning per share, dividend payout, which are often practical value, or going for practical uh, investing in value to make a value out of the investment. There are three basic things which I've tried to point it out when you are making an investment into the market, or you are day trading. That's these which I have pointed out. Where you are doing a technical analysis, risk return ratio, number one thing which you should know, which we try to provide on each and every recommendation to our client, and have been communicated to most of the clients. Trade setups. When you are doing a trade setups, like in previous slide, I have told you about trailing stop losses, booking profits. Where you must book 70% of the profit on first target, or 50%. You can trail your stop loss to your cost price and hold 50% or 30% of the position for second target or third target, and then trail stop loss. Trailing a stop loss will give you at the end of the day profit itself, so that it doesn't give you a negative payout at the end of the day. So these are the three basic strategies which you must know in technical analysis. Value investing, well, you need also financial advisor or expert advisor. That well, there are three basic thumb rules which apply. Earning per share, you need to look at the numbers, price to book value, and dividend payout. If earning per share is good, price to book value is a pretty much low, and dividend payouts are there on a constant basis. Value investing will help you make a capital appreciation. But I would also point out that it is for 6 months, and people seeking for capital creation is for 3 years. So there is a difference when you go for value investing. While on a daily trade setup, we have a positional traders, we have a day trader, and short-term traders. I'll take you to the other slide. Uh, Day trading strategies. Now, when you go for day trading strategies, uh, there you should know what are the initial setup, your trading account, your initial setup, how the brokerage is, what is the brokerage you are paying, what is the profit you are making, or what is the loss taking capacity you have. Daily work, which an investor client is not meant to do, but this is one of the things which I would suggest that you all should have a list of to do things if you are a pure day trader. But if you are just an investor who's trying to make the best out of the market, it's just to make you aware about the market. Identify steaming stocks. What are the stocks that are steaming, which have a momentum, which have some liquidity in that market, or which have some volatility? So these are the steaming stocks which you try to identify. Verify steaming stocks. Verifying is another thing. When you have a steaming stop, not every stock is going to make the best out of the return. So you need to verify that steaming stocks as well. Daily work, finalizing. Finalizing is another word when you come onto the market. Once you verified your streaming or make to conduct a final quick check against the moving average, conduct convergence, divergence. I've just put it on as an example. Well, there are many things like Bollinger Bands, relative strength index. Then you have tools like Fibonacci retracement or trend lines, which help you making a decision. Now, Epic Research Trading Strategies, this is a strategy we try to communicate to client on a daily basis, and we also suggested them on a daily basis. Also, through this webinar, I'll let you know about this trading strategies on Epic Research recommendations. First, I'll start you with an example. I'll try to explain this slide. Uh, if you receive a signal which says above certain value, then you have to wait for execution or put a pending and stay in queue at the particular price as given. Now, I hope you understand this particular thing as a trade trader. For example, if we have given a buy signal on Denko Industrial with a code of 8176 at above. Now, this is one of the critical words above. When you have seen this particular level above, you must know that this is one of the levels which we give above 0.4130. Sorry, uh, just me. Yes, above 0.430. When I say above, your entry point should be above 0.430. You don't have to buy at 0.430. You need to buy at 0.435 or 440. But try to keep this distance, try to keep this spread as less possible. So this is where you need to have a speed in your trading strategies. Then you have targets and you have a three targets. So you, if you see the overall return from this particular is from 0.435 to 0.540. Now that is almost 100 movement, which we have hundreds in movement, and then you have a stop loss which is just 0.380. Now this is what I've told in earlier about the risk reward ratio. When you have a risk of 0.50 cents, you have a return of almost 100. So this is like having a risk of 1, but you have a return of 2. So this is one of the critical parts at Epic Research we try to maintain. Here you have to wait for Danko to reach 0.435440. If signal is from CMP, then you need to have a high reaction time and need take an immediate entity. Now this is one of the critical questions that traders ask, that what is above and CMP, which I have explained. CMP is you have to buy at this point 0.430. Now and not everyone would be able to buy at that particular price, so we give you a range of that 10 cents. See, when you are entering into the market as an expert, I personally would like to explain that there are some levels that work in the market, having a support or resistance where we have to use above, but at times there are already signals which have given a buy signal. It can be RSI, it can be MACD, it can be Bollinger Bands, or it can be moving average. All these indicators at some point of time we try to have a breakout in particular counter. Above is one of the things we used in that. But when you are using CMP, so it means that we already have a buy signal on this particular counter through our indicator, through our signal, and we recommend you to buy at current levels. It is one of the parts where also a conviction of the analyst comes in. In above symbol you have to immediately make an entry in the given range. You can enter at 0.430, 435 or 440, but try to keep this spread as low as possible because it will eat some of your profit. That is very minimal in nature, but usually will, if doing it in 10 trades, it will amount to much higher. So try to keep this spread very low and have a quick response time, like I shared earlier, that speed should there be with you. In case you miss entry, immediately message your agent for the same. Most of the time, when we give recommendation and then investor comes in at the end and says that I couldn't get entry, or I was not able to make entry in this particular signal which may have achieved a second or third target. So you need to inform us or your agent for the same. When you see that signal states CMP, then you have to make an immediate entry and your action should be very fast. When you are having a CMP, it is easy for you, but when you have an above, you need to be uh, immediate and fast as well. So in both cases, you must inform the agent or the expert that you couldn't be entered, and should you enter now or should you enter not. You receive three targets and you have to exit 60 to 70% quantity on first target, and trail profit 50 to 20% of second target, and took profit on 10 to 5% on third target. You must be know that what is your investment, so we advise trading in multiple lots or multiple quantities so that you can book 60 to 70% of the first target. When you're booking 60 to 70%, you're making sure in the market that you have made the best out of this particular recommendation. Rest of the 15% to 30% which you still have, we have second and third targets to take profit and revise your SL. Trailing stop loss is compulsory in day trading strategies. Follow given stop loss and always revise a stop loss if waiting for second and third target. You must trail your stop loss near to cost, or if you're waiting for third target, I would recommend you should uh, uh, trail your stop loss on first target. If you're waiting for second target, you should trail your stop loss at your cost price, which is this. So this will optimize the overall return and churn the return of the portfolio, and the best strategy you can have on daily basis. If your trading terminal does not allow you to put target price in advance, then need to put Q for sell at our given target price just after the execution. Many of the brokers we have had communication with our clients doesn't allow to put you target when you are entering a trade or when you're initiating a position in the market, buy position in the market, for example. So you cannot put target. So when you are not able to put target, it is advised you that you need to put Q for sell at our given target price just after the execution of this signal. This is one of the basic strategy that I would like to share with every clients and traders we have here. Epic Research Trading advises. Uh, we have developed some of the advices which we have on Epic Research trading websites as well, which we have shared. Uh, we believe and guide all our traders to very strictly follow these strategies. If you try to be as simple as in your trading strategy, have discipline, these two things will try to do best in your market. They will work for you in the best way, and you don't have to worry about the external factors like news or any event. If you have a simple strategy in your mind, if you have your profit in your recommendation, if you have your suggested stop loss, and if you have your level, you just have to have a discipline to follow them, so you try to make the best out of the market. Only buy or above or below the level suggested, or sell below the level suggested or as recommended, that can be at CMP, which we discussed in last slide. Always keep proper stop loss in all your trades. Keep booking profits and trail the stop loss as advised to you. Do not trade in trials and only observe the clients. We recommend this to each and every investor across the global market. See, we are giving you trials not to make money out of it. You need to observe them. You need to find a rhythm with them. You need to find how we are generating recommendation, how we are generating calls, and make sure you have a tuning with it. When you have seen this particular calls or our recommendation, then you go for the services, but don't trade in trials. We just provide trials to make you observe about the market. Never overtrade. Never invest all your capital in single recommendation or single counter. Trade with setups. Invest 30 to 40% in each recommendation so that you still have other portfolio left to invest in the market. Never trade on rumors. Of course, you never should trade on rumors. Always consult our advisors in case of any confusion. We suggest to trade on all our calls and maintain uniformity in trading patterns. Maintaining uniformity, that is what I suggested. You need to invest equal capital in every trading recommendation we provide. Do not change the trading capital lots in the middle of the month, as this will disturb your risk reward portfolio. If you're investing same capital and same uniformity in every trading pattern, you'll have the best return in the end. But if you imbalance the capital or the lots in the middle of the month, it will disturb the overall risk reward ratio. Those trading in single lot or single quantity need to book profit in the first target itself. I would also advise there are certain categories of investors that can be from uh, conservative to aggressive. So if you're a conservative investor, you need to book profit in first target. If you're an aggressive investor who has an expertise or you're a seasoned trader uh, in the market, so you can wait for second and third target, but you need to trade your stop loss. Now these are the charts which I would like to share with all the investors we have. We have this FTFBM KLCI daily chart. Now it is coming at 1720. I've put on two averages, that is 50-day and 200-day, which is right now giving a negative signal. But now this, if you see, is one of the markets like which has been in a trend, and this is one of the areas which is forming consolidation part between 1745 to 1680. This is one of the critical levels. Now technical analysis does tell you price and history repeats itself. So if you look at this particular uh, level back in 2014 December when we had a bullish run in the KLCI. If you have seen, this is one of the places where you had an RSI bottomed out. This is relative strength index. This is one of the levels. Now, if you see, we have seen a rally of almost 100 points from there, from 1675 to 178090, or more than that, I mean, levels. Now, we have seen a slide. Now, history repeats itself. If you see these particular level way back, where 200 days prices. Now, this is one of the levels we have seen a decline. Here, you can see the decline. After almost a year, we came back to the same level. Now this is one of the level. Now see the same thing that happened. History repeats itself. Now this is the level, and you can see the slide to the same level, and it is consolidating in the same direction. So history repeat does itself. There are certain support and resistance which are being formed. Like for example, this is one of the resistance in the market which is formed. You just need to have proper signal or proper advisor who let you know that this is one of the area where you need to profit. And this, like, is one of the support. Now see this same thing here. So this is one of the things, like here. This is one of the support. Now this is one of the resistance which we see. Now this is one of the supports here. Now this is complete. It is the major trend, the major area. One needs to know that this is the trading area. Now this particular points are the setups. These are the key points where you need to know that this is the entries points if you have proper RSI, like same here. Now if you see, we have a bullish divergence in particular prices. If you see, the prices were in a fall here, right? Now see the RSI, how it is reacting to this. This is relative strength index. Relative strength index have two levels, that is 30 and 70. The 30 signifies the oversold, the 70 signifies the overbought, and these do work. Here if you see, it is falling, the market is coming down. RSI has already tested this level. Now market did again came down and broke the previous low here, but if you see, RSI here is making the higher bottom. This is one of the things where you need to know that prices are making lower lows while relative strength index is making higher bottoms with higher tops. If you draw a trend line over here, you'll be able to recognize that. Okay, so here is one of the points where if you know that you have an indicator which is showing a reversal from the oversold zone, you can see that market did give a good return of 30 odd points here, if you know how the particular indicator work and what is the entry point you should have. Now this is KLCI weekly chart, which I have tried to share with you. The market has been in a bull run, continuous bull run since 2011. There has been particular points of entry. If you see this, 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 and this are the points. All my arrows, if you have seen, are one of the points where you know to know that you have a particular point of entry time. Now this particular market has given you an entry time of more than 1, 2, 3, 4, 5, 6 times. It has also given you profit. Now as I have said earlier that trending markets are good, but if you know what is the range, what is the price action or the price pattern, it will happen 70% of the time, and these 70% of the time you can make profit. If you see that this has been the resistance and this has been the support zones, the reversal did happen here. As simple strategy as that: higher top, higher bottom, higher top, higher bottom, higher top, higher bottom, higher top, higher bottom. As simple as that. In a market which is in a trend, you should know what is the entry price. Now, there are not much, but if you see, it has given you more than 5 times entry points and opportunity to book profit. If you must have entered here, you could have booked profit here, or you could have trailed your stop loss above your cost price. You can bought here, here. You can stop, revise your stop loss here. These are the levels where the lower points work as support and stop losses in your market. The upper points are the ones where you need to book profit. So these are one of the trade setups, as simple as that. When you're in a bull trend, higher tops, higher bottoms are forming. You must know when to enter and when to book. As simple as that. Now this is one of the area where prices have reversed. We have seen a lower top and a lower high formation. If you see this, now we are at the lower part of this particular trend. If you see the trend line here, here. Now this is one of the point. Now it doesn't mean that your trend is over and you don't have any trading opportunity here. You also have a trading opportunity here if you know how the work, and you can make sure you have the right trading setup. Like for example, this is where the RSI is again at 30 levels, price are at that 200 days moving average. So one of the points where you can take an entry. This is SGX daily chart, Singapore Exchange. it has been in continuous uptrend, pretty much same if you see in Asian markets, most of the charts are pretty much same. Well, this is as same as the Malaysian market chart which I've shared, almost an uptrend. Your profit areas, this is where the trend changed. Then you have a lower low, lower high, lower low, lower high, lower low, now upper high. It might be that this particular area has given a breakout here, and this can be a double bottom breakout or a W breakout, and you may see price going up from here to this level. Prices tend to retrace back to the uh, breakout area. As this is a daily chart, you'll see a lot of volatility on daily basis. But if you have a knowledge of a bit of technical analysis, you would know that how does the thing work here. This will be the first point of resistance, this will be the second point of resistance. You must see here when the price is making lower lows, the RSI is making higher highs. So this is one of the reversals. In crimes of value investing or technical analysis, you should know what are the indicators that you need to follow. Now, when our prices are in consolidated zone, RSI is in a uptrend. That means the market have bottomed out. You can make a positions at this level. Now there hasn't been much of a deviation in this particular level. It has been a 40 points range where the market tried to bottom out, and we see a current rally. Now the best that can happen on Singapore exchange market is that prices may retrace to 33.20, 33.30, but this is one of the moment where you need to see that there will be a reversal and you may have a positive breakout. This is the weekly chart of Singapore exchange. I've tried to draw some trend lines over here. You see how the price reacts to the trend lines, and this is the upper resistance line. So this is one of the areas where you need an expert advisor who will tell you that what are the initial setups that one should take best out of the market to make sure you have optimum return of the portfolio. Epic Research tools. We at Epic Research have many tools. We try to provide a very transparent process, regularly update all the call performance on our website, which you can visit at the same. You can see the track sheets at www.epicresearch.my or Singapore. You have a research report we update on daily basis, also weekly basis. Sorry, epicresearch.sg/reports, epicresearch.my/reports. Singapore website we can visit us at www.epicresearch.singapore, and Malaysian website is at www.epicresearch.my. You can call us on 6531 581402 or 603502 19047. If you like to have any queries, I'll be surely have to take, and I'll take your queries from now. And if you have any queries, you can ask to me. Okay, one of the uh, investors have seen what is the federal rate hike which we are having in September. See, federal rate hike is nothing but that after 10 years, the Federal Bank of USA is going to raise their interest rate. Now, it is not sure that it will be in September or in December, but it all depends on data. Like in last week, we have had a US jobless claims that were coming at 40 years low of 255,000, which was way expected, way below the expected of 2,70,000. So it is one of the data that has helped US economy to make sure to have a decision on the federal rate hike in coming September or December, but we will all take the data which we are having continuously on weekly basis and daily basis. So we need to understand that what is the effect of the data, and there might be very soon a federal rate reserve hike. One of the questions that is asked that how much capital should be employed on every trade. See, even if you are trading with the 10,000 capital, uh, you don't have to invest completely into the market. You can wait uh, and just invest 30 to 40% in one recommendation so that you have other 60 to 70% left for the other recommendation that you have. So you don't have to invest complete capital in a single trade. If you are having a 10 to 20,000 capital, you can invest 5 to 7,000 capital in one single trade. When you make profit out of it, so that you have a profit as well as some kind of capital as well in your portfolio again to trade on any other recommendation. One of the questions that is asked is, what do you think of Singapore exchange at this particular moment? See, as I have the charts where at informational purpose, though I've tried to analyze them and have some knowledge to you, but as far as Singapore market is go, it is in overall bull run, and this particular bull run is yet to stay. Though there can be some kind of a pullout due to federal rate hike, but in Asian market that will not see that much of negativity because most of the things, as I say, price discounts everything. So when you have most of the news coming in, you must know that it is already being discounted, and you must know that how the market is reacting into things. So if you have an expert with you, the news and the event does will not have much of a impact on the portfolio if you have, because as a trader you don't have to wait for every news and analysis. You just have to wait for your recommendation and try to book profits at given targets so that any of the news won't even affect your overall trading strategies. Well, as this is one of the moment where I have to say and leave you, because we have completed 1 hour of our webinar, and you can call us and reach us in case if you have any queries or if you have any uh, doubt about the market or about any particular event that is happening. You can visit us at uh, www.epicresearch.sg or www.epicresearch.my, and you can call us at 6531 581402 or 6035021947. Hope you guys have a happy weekend, happy trading. Thank you.